Hey everyone, welcome back. Today, let's talk about one of the most stable and consistent performers in the Indian stock market, HDFC Bank, and its Q2 fiscal year 26 results. The stock is currently trading around 1,000, not far from its 52-week low of about 920 and high of 1,190. It continues to dominate India's private banking space and is seen as a safe compounder by long-term investors. Now let's look at the numbers. For the quarter ended September 2025, HDFC Bank reported a net profit of 18,641 crore, which is up almost 11% year-on-year. Revenue stood at 45,900 crore, marking a 10% annual growth, and core net interest income came in at 31,550 crore, up around 5% compared to the same period last year. The net interest margin, or NIM, stood at 3.27%, slightly down from 3.35% last quarter, mainly because deposit rates have moved higher, forcing the bank to reprice older deposits. Still, those are strong margins considering the current interest rate environment. A key positive this quarter, provisions dropped sharply to about 3,500 crore, down from over 14,000 crore in the previous quarter. That's a clear sign of improved asset quality. Gross NPA now sits at 1.24%, and net NPA at 0.42%, making HDFC Bank one of the most efficient lenders in India. On the business side, advances grew close to 10% year-on-year to around 27.5 lakh crore, driven by retail and SME loans. Deposits rose around 12%, reaching approximately 28 lakh crore, proving the bank's strong retail franchise. The cost-to-income ratio also stayed healthy, around 39%, showing operational discipline. Now, let's discuss investment levels. For short-term traders, entry zones lie between 960 and 1,000, with targets around 1,080 to 1,150. Keep a stop-loss at 940 to manage risk. For long-term investors, the 950 to 1,000 range remains a good accumulation zone, targeting between 1,150 and 1,200 in the medium term, depending on future performance. So, what's the bigger picture? HDFC Bank continues to lead the private banking sector, backed by strong profitability, disciplined risk management, and steady credit growth. Yes, there's slight margin pressure now, but that's temporary. As deposit costs normalize, margins should gradually recover. The post-merger integration is also stabilizing well, further strengthening the balance sheet. Overall, HDFC Bank remains a steady compounder, not a flashy multi-bagger, but a consistent performer built on reliability and discipline. For investors seeking stability and steady compounding, this stock remains a must-have core holding for the long term. If you already hold it, stay invested and let compounding do its work. And if you're waiting for entry, dips near 950 to 1,000 look attractive. That's all for this update on HDFC Bank Q2 FY26. If you found this analysis helpful, drop a like, share it with fellow investors, and don't forget to subscribe for more smart analysis. Thanks for watching, and happy investing.